how can an asset simultaneously flash a strong buy signal on the short-term dashboards while, remaining completely trapped in a massive long-term bearish downtrend?
Yeah, it's a wild contradiction.
Right. I mean, are we looking at the ultimate undervalued opportunity of the decade right now? Or is this just a textbook value trap designed specifically to catch retail investors completely off guard?
It really is the ultimate paradox in modern market structure, because you have this single vehicle screaming two entirely different narratives, depending entirely on which time horizon you prefer to look at.
Which is confusing for anyone trying to track it.
Exactly. Like a daily chart tells you to back the truck up and buy, but a yearly chart, that one tells you to run for the hills.
Yeah.
And that tension, that specific contradiction between the timelines is where fortunes are going to be quietly made or honestly spectacularly lost.
We really have a lot to unpack today because we are diving deep into the BlackRock iShares Bitcoin Trust, ticker symbol IBIT.
A fascinating asset to look at right now.
It really is. And our entire mission for this deep dive is to cut through all that relentless noise surrounding it. We're breaking down the raw data, the internal mechanics, the technicals, and the underlying market sentiment as we sit here in mid-April 2026.
Stripping away the emotion is really the only way to actually understand what's happening here. I mean, the underlying asset inherently brings out, tribalism and extreme emotion.
Oh, absolutely.
But the institutional capital flowing in and out of it, that operates on cold, hard math. If you know how to read the data, it tells a remarkably objective story.
Before we pull apart that data, though, I have a quick favor to ask you, the listener. Please like the video, subscribe to our YouTube channel, and it is absolutely compulsory that you leave your comments and feedback below.
Yes, we really want to hear from you.
We read all of it, and we want to know what you think about this tension we're exploring today. Now, to even begin analyzing this ETF, we have to kind of throw out the traditional playbook, right?
Oh, completely.
Because if you pull up this ticker expecting to run a standard valuation model, you're going to be instantly lost.
You'll be staring at a completely blank page. I mean, if you dive into the financial filings for IBIT, there is no traditional income statement to analyze.
Nothing at all.
Right. You won't find a balance sheet listing physical property or equipment, and there is absolutely no cash flow statement showing quarterly revenue growth.
Looking for an income statement on a spot Bitcoin ETF feels like, looking for a spark plug in an electric vehicle.
That's a great way to put it, actually.
The entire mechanics of the thing are just fundamentally different. It's not a company producing a product.
No, it's essentially a vault. A digital vault is the best way to conceptualize it. Structurally, IBIT is a grantor trust.
Okay, so what does that mean for the numbers?
Well, its financials are completely tethered to just two metrics. Its net asset value and the direct physical Bitcoin it actually holds in custody.
It doesn't sell software, it doesn't manufacture goods.
Exactly. Its entire health is measured by its assets under management, which currently sits at an absolutely massive $57.64 billion.
Almost 58 billion. Just let that sink in for a second. That is a staggering accumulation of capital for a financial vehicle that, didn't even exist a handful of years ago.
It's unprecedented, really.
And the mechanism driving a lot of that adoption is the fee structure. They charge a 0.25% expense ratio.
Which is incredibly low.
Right, which means BlackRock is taking a razor-thin margin to manage the fund, handle all the custody security, and deal with all the administrative headaches.
And that aggressive fee structure is the battering ram BlackRock used to capture so much market share. But, the scale of that $57 billion often masks the sheer violence of the price action inside the trust.
Yeah, traditional finance is used to, single-digit percentage moves over a year?
Right, exactly.
Which brings us to the whiplash. Let's look at the 52-week range. Back on October 6, 2025, this thing hit a high of $71.82.
A huge peak.
But then fast forward just a few months to February 5, 2026, and the floor just completely falls out. It crashes down to a 52-week low of $35.30.
Yeah, that is a brutal 50% haircut.
On a multi-billion-dollar institutional asset in just a matter of months.
And this is exactly where standard metrics completely fail the average analyst. I mean, we aren't looking at a blue-chip tech stock that just missed an earnings call.
Not at all.
We are analyzing a trust that perfectly and ruthlessly mirrors the extreme psychological swings of the broader crypto ecosystem. but it's doing so wrapped in a traditional Wall Street wrapper.
Let's ground this in the present moment then. We know what it is, and we know the historical extremes.
Ah.
As of the latest close on April 14th, 2026, the price is hovering right around $42.13.
Right in the middle there.
Yeah. And what immediately jumps out at me is the liquidity at that price point. We are talking about an average of roughly 43.04 million shares trading hands every single day.
That volume is critical because for institutional players, liquidity is oxygen.
Oh, totally.
When you have 43 million shares moving daily, it means a massive hedge fund can enter or exit a 9-figure position almost instantly without causing a massive ripple on the chart. They aren't getting trapped in the asset.
And speaking of those institutional players, the sources show over 1,676 institutional owners on the books right now.
A massive footprint.
We are talking about the apex predators of traditional finance here. Millennium Management, Goldman Sachs. Together, they hold roughly 379 million shares. And over the last year alone, institutional inflows hit $7.57 billion.
And that capital represents a tectonic shift. It isn't, a swarm of retail day traders firing off stimulus checks on an app.
Right.
That is calculated, methodical, long-term capital being deployed by some of the most sophisticated risk management algorithms on the planet.
Wait, hold on. We need to pause right here. You just said a Wall Street poured over $7.5 billion into this trust.
Yep, $7.57 billion.
But the price is sitting at $42, and the 52-week low is $35. That math just doesn't add up to me. If demand is that heavy, if billions are flowing in, why isn't the price rocketing back towards 70? What am I missing here?
It's probably the most common illusion in market analysis today. People see the headline billions in inflows, and they just assume it must translate to immediate upward momentum.
Right. Buying pressure usually means the price goes up?
Usually, yeah.
Right.
But for every single one of those institutional buy orders, there had to be a seller on the other side. What the data actually reveals over the last year is a massive, sustained distribution event.
Meaning the early adopters were basically just cashing out?
All the way down. The retail investors and the crypto-native miners who rode that euphoria up to $71 were taking profits and then panic selling as it dropped.
Oh, wow.
Wall Street wasn't driving the price up. They were stepping in as the buyer of last resort. They used that massive sell-off as a generational opportunity to accumulate.
So they were essentially standing at the bottom of the cliff with a giant catcher's mitt.
Precisely.
The billions of dollars in buying weren't enough to push the price up. They were just barely enough to absorb the avalanche of selling pressure that drove it down to 35 in the first place.
And they do it very quietly. Institutions don't use market orders that spike the price.
No, they're smarter than that.
Right. They use algorithms designed to buy in tiny fractions over months, deliberately keeping the price suppressed within a tight range so they can build their positions at a steep discount.
That perfectly explains the stagnant price tag. But to figure out where this is going next, we have to look under the hood at the technical analysis. We need to see what these algorithms are actually reacting to right now.
And this is where it gets really messy.
Yeah, the sources highlight a massive clash of signals.
Well, the short-term trend is undeniably showing strength. We saw a 1.30% bump in the latest session.
Okay.
And if you look at the momentum oscillators like the 14-day relative strength index, the RSI, it's hovering comfortably between 57.52 and 59.04.
So it's flashing a solid neutral to buy. The momentum is trending upward, but it hasn't crossed into that overheated, overbought territory yet. There's still room to run.
Exactly.
And the mass CD is backing that up, right? The sources show it between 0.37 and 0.55, which is staging a clear bullish crossover.
Yes. And the algorithms zero in on that mass CD crossover. It signals that the short-term upward energy is actively outpacing the long-term historical drag.
So the machines are buying.
Right. When automated trading systems see short-term momentum overtaking the average, they start triggering localized buy orders. The machine basically sees a green light.
But the machine is only looking 10 feet down the road, because when we zoom out and look at the moving averages, the entire narrative flips.
It completely reverses.
The 50-day moving average is sitting right below the current price, between 40.55 and 41.71, acting as a nice supportive baseline. It's holding things up around 41 bucks. But then you look up.
And it gets ugly.
Yeah. The price is deeply trapped, significantly below the 200-day moving average, which is towering over the market way up in the $39 to $54 range, but effectively acting as a massive ceiling up near 54.
In the realm of technical analysis, that 200-day moving average is the ultimate psychological and algorithmic line in the sand. Institutional trend followers use it to define the entire macro environment.
So because we're below it.
Because we are trading in the low 40s,
Yeah.
so far below that $54 mark, the long-term algorithms still view this asset as fundamentally broken. That 200-day average isn't just a number. It's a heavy concrete ceiling.
I'm picturing this as a massive squeeze. We have these hard floors of support holding the price up. There's a hard layer at $41.60, a deeper one at $39.58, and a final trench down at $37.
Yeah, lots of support.
But right above our heads, we have these immediate short-term resistance ceilings at $43.19 and $47.49.
The price is completely boxed in right now, and this structural claustrophobia is exactly why consensus ratings across the street are so wildly mixed.
All over the place.
You log into a short-term trading platform, and the daily oscillators are screaming, "Strong buy!" But you pull up a macro trend tracker, and it's issuing a cautious hold or even a sell warning.
It's essentially like a weather forecast telling you it's a beautiful sunny day outside today, which is your short-term buy signal, but actively warning you that a hurricane is sitting right off the coast.
That is the perfect analogy.
You can go out and enjoy the sunshine today, maybe scalp a quick trade, but you better have your bags packed if that long-term bearish hurricane decides to make landfall.
That captures the exact anxiety of the market right now. And that underlying anxiety feeds directly into the biggest debate tearing the crypto space apart right now.
The undervalued versus value trap debate.
Exactly. Is this $42 price point a rare generational discount? Or are we looking at a classic value trap designed to crush retail?
Let's tear into that debate, because to figure out if something is undervalued, we usually look at its intrinsic value. But as we established with the electric vehicle analogy earlier, there are no earnings here. The intrinsic value of IBIT is 100% tethered to the spot price of Bitcoin. Mechanically, every share of IBIT represents roughly 11/1800th of a single Bitcoin.
Right. So the analysts pounding the table, calling this undervalued, aren't really analyzing the ETF itself. They're projecting the future of Bitcoin.
They're looking at the macro models.
Exactly. They are mapping out models that put Bitcoin at $150,000 or even $200,000 by 2027. And if Bitcoin scales to 200K, then by sheer mathematical default, IBIT has to multiply in value. For the bulls, $42 is the steal of the century.
But the bears look at that exact same setup and see a textbook value trap. I mean, a value trap usually lures you in because an asset looks cheap compared to its historical highs.
Yeah, it's a very common trap.
People see a drop from 71 to 42 and think, oh, it's on sale. But it's cheap because the underlying momentum is deteriorating.
And the traditional finance crowd gets very nervous here because it relies so heavily on the greater fool theory.
Because there are no dividends.
Right. Since there is no dividend to pay you while you wait, and no underlying corporate revenue to stabilize the floor, your entire investment thesis relies entirely on the hope that human psychology will compel someone else to pay more for it tomorrow.
Is it fundamentally dangerous to call something undervalued when its entire valuation relies on the hope that someone else will pay more for it rather than it actually generating revenue today?
It's incredibly dangerous, which introduces massive real-world risks that retail traders constantly underestimate here. First, you have the extreme trapping volatility.
Yeah, this isn't a slow-moving utility stock.
Not at all. The price can, and frequently does, violently gap up or down based on a single late-night headline out of Asia.
And then you layer on the regulatory overhang. The legislative environment around digital assets is still, largely unwritten.
Very much so.
A single aggressive pivot from regulators regarding crypto services can send a chill through the market that instantly freezes those institutional inflows.
But the most revealing risk, and this is the one that really stands out in the data, is hidden in the options market.
Yes, I wanted to get to this.
The sources point to a very specific metric, a persistent 2-month put-call skew bias.
Okay, break that down for me simply. What does a put-call skew bias actually reveal about investor psychology right now?
Well, to borrow your weather analogy, it's the equivalent of looking out at a perfectly sunny day, but noticing that all your wealthiest neighbors are quietly buying massive flood insurance policies.
Oh, wow.
Even though the daily chart is showing upward momentum and flashing buy signals, institutional players are actively paying a premium to hedge their bets. They're loading up on downside protection, specifically targeting the next 2 months.
So they're smiling for the cameras on the short-term trades, but quietly buying life vests under the table. That is incredibly telling. The money doesn't trust the sunshine. And that exact danger is why we need to lay out the ultimate worst-case scenario, side by side with the absolute best-case scenario. Let's start with the bear case. How ugly does this get if the floor breaks?
In a true bear scenario, the macro environment tightens further. Speculation just completely dries up.
So retail leaves.
Right. Maybe regulatory hurdles tighten globally, and the speculative fervor that drives retail into crypto completely evaporates. Under that pressure, the technical support levels we discussed simply crumble.
If it breaks below that $35.30 floor from February, there is very little historical structure to catch it.
None at all.
It triggers cascading liquidations, and the price just enters a sustained downward trajectory. Anyone who bought the hype at 70 is left holding a very heavy bag.
With no guarantee of a timeline for recovery. But then, we pivot to the bull case.
The best case scenario.
Right. And that is anchored by massive structural pillars. The first is mathematical scarcity. Unlike fiat currency, the supply of Bitcoin is hard capped.
Right, at 21 million.
Yes. Second, you have the historical halving cycles, which mechanically slash the amount of new supply entering the market, creating these recurring supply shocks.
And the third pillar is the BlackRock machinery itself. This is the largest asset manager on the planet. They have an unmatched global distribution network.
It's unparalleled.
They can seamlessly funnel money from sovereign wealth funds, corporate treasuries, and sleepy pension funds directly into this asset. No crypto-native platform could ever dream of that kind of access.
Exactly. So when you synthesize those opposing forces, the outlook splits perfectly between timelines.
Okay, what's the short-term outlook?
In the immediate short term, the consensus is heavy consolidation. Analysts expect that immediate resistance overhead, right around $42.25, to hold firm.
So it's going to bounce off that ceiling?
It will likely reject the price, forcing a brief pullback down to that $40 baseline, just to catch its breath before it can even attempt a real breakout.
Just sideways chop while the market digests all this institutional buying. But what about the medium to long-term outlook?
The institutional thesis for the long term is highly bullish, and it hinges on this concept of sticky capital.
Sticky capital.
Right. When a retail trader buys Bitcoin on a phone app, they might panic and sell 3 days later because of a scary news headline. That creates legendary volatility.
Sure.
But when a massive state pension fund allocates a position into IBIT, they aren't checking the daily chart. They are holding that position for a decade.
They rebalance quarterly. They don't panic sell.
Precisely. They operate on a completely different cadence. The theory is that as this massive wall of sticky institutional capital slowly overtakes the fast-twitch retail money, it will mechanically bleed the legendary volatility out of the asset entirely as we march through 2030.
So the bull case is essentially that Wall Street's boring long-term retirement money is going to finally tame the Wild West of crypto.
That's the grand experiment playing out in real time.
It's a fascinating concept. Now, before we wrap up today, I need to explicitly remind you, our listener, that everything we've explored today is strictly an analysis of the provided source data.
Yes, this is absolutely not financial advice.
We are impartial guides exploring the mechanics of this material. We are not taking sides, and we are certainly not endorsing any specific trades. Always do your own research.
The data remains fundamentally conflicted. The tension we discussed at the start, that collision between a short-term breakout and a long-term bear trap, it remains entirely unresolved today.
The market is holding its breath, waiting to see which timeline breaks first.
It really is a Mexican standoff between the daily chart and the yearly chart.
And that leaves us with a massive philosophical paradox to close on. Think about this. If the ultimate goal of Bitcoin was to be a decentralized rebellion against traditional finance, what happens to its soul and its price when Wall Street's sticky capital becomes its absolute biggest owner?
It's the ultimate question.
Is traditional finance finally taming Bitcoin? Or is Bitcoin acting as a Trojan horse, quietly sneaking its way into the very foundation of Wall Street? Something for you to mull over until next time.